Great to see everyone on this call today. I'm excited to share a topic that's very near and dear to my heart. I am a competitor at heart, and I'm always looking for an edge over, how we compete and how we make money, obviously. And I'm excited to at least talk about, some of the things that's at the top of my mind. I want this webinar to be probably no more than 40 minutes, 45 minutes. So we're going to breeze through a couple of the slides, but they're really important slides because they highlight critical things that I'm thinking about, data that we're looking at as Trophy Point crafts its offerings to the general, private lending, real estate private lending audience. So for those of you that don't know me, and I see a lot of folks that I've never met or talked to actually on this particular webinar, so I'm happy that you get to meet me, you get to hear from me. I own real estate, I teach real estate, I manage Trophy Point. We've done quite a few deals. I'm an Army officer. I'm still in the reserves actually, and I graduated from West Point, and I also have an Emory MBA degree as well. My favorite thing is solving problems. I love solving problems. So you have my number there. Feel free to text me or call me if there's a real estate specific problem that you have or life problem. I'm happy to help you with that too, if necessary. But at the end of the day, I don't like watching people lose money in real estate because this is a game where you really cannot afford to lose money. If we think about investing and we think about what we do in terms of growing our wealth, compounding is the name of the game. And you hurt your compounding abilities when you suffer from a loss. So capital preservation is probably the first thing that I look for in real estate investments and things like that. So, if you've got a conundrum on your desk and you need a second opinion, or you want someone like myself to opine on it, I'm happy to do that, and I make myself available as much as possible. And my number is right there. So real quick, for those of you that don't know what Trophy Point does, I'll just reiterate it briefly. We are a hard money lender or a private lender on real estate. In many ways, we operate like a private bank. So we have investors and we give investors 8 to 12% on their money. And the rate you get on that 8 to 12% depends on how much money you put into the fund. Obviously, more dollars will get you a higher yield. And then we take your dollars just like a bank and we lend it out at higher rates, thereby creating a spread. And we always have a first position lien on it. We always have personal guarantees from our borrowers. We do a lot of things to make our loans safer. Nothing is safe in this world, but we do a lot of things to make it safer in order to preserve our capital and ensure we're getting paid the yields that we're promising you as the investor. That being said, there's a huge tendency for lenders like myself to just sling loans throughout the entire market because we make money on fees and on that spread. And so if I'm taking your money and I'm just optimizing just for fee income, then our incentives are not aligned. I would be more inclined to just approve loans for the sake of approving loans to collect a fee up front, and then there could be a huge problem on the back end if loans don't perform or pay off as intended. So really, to protect you as the investor and also to protect me for myself, I implemented what's known as a first loss position on the money that I have personally invested in the fund. And I have $8 million with Nick and Dave, my two partners. We have $8 million, actually a little bit more now, in the fund, and we take the first loss on all the loans that we make. So we would have to get wiped out completely out of our 8 million first before you as the investor would take the loss. And I think those are pretty strong incentives. I think you want to be in bed with a fund manager that has real skin in the game and will eat their decisions if they screw it up. Unfortunately, we haven't really screwed it up at all, actually. We've had defaults, but we haven't had a principal loss on any of the loans out of the 200 million that we've done so far. And then, also to keep defaults low and to reduce our risk, we focus on certain types of people, mainly military affiliated folks. Dealing with them has been a lot easier than dealing with regular civilians. No offense to anyone that's not in the military or hasn't been in the military. But when there's a problem, I can easily solve a problem with a 10-minute phone call. Whereas when you're dealing with a general wider population, I may have to hide behind a lawyer. And as some of you know, whenever you call a lawyer or you engage a lawyer, that's a $2,000, $3,000 bill right up front. And, I'm not about the lawyer donation industry. So I try to solve problems by myself as much as possible. And who you do business with matters a great deal. And we mitigate that risk by dealing with high character people in the beginning. So anyway, that's us in a nutshell. January, so a January update for existing investors. We've got 233 investors now. We've earned 500 grand almost in interest last month, which goes to all of our investors. Our fund has grown significantly. We're 330 loans across the board, and we now manage 83 million. By comparison, in January of 2024, we were around 50 million. So we raised quite a bit since then. And sorry, I know you can't see it, but January, December, November, these are the months that you see here on this chart. And so we're making more loans as intended, but we're also getting a steady stream of payoffs as well. And so, we're collecting anywhere between 2 and 4 million a month in payoffs, which is great because it shows that our underwriting is correct. It shows that there's a liquid market. It shows that this market is healthier in terms of getting paid back. Trophy Point has a referral program. We pay $1,500 for any new investors that join the fund. Just text me or Danielle at this number right here with a referral, and we'll take it from there. All right, so let's get into the meat of today. All right, so housing market. I've got this broken up into two sections, and you can tell by the different colors. And for our purposes today, to just kind of set the stage, I'm kind of looking at the world pre-COVID and post-COVID. And that may not be the perfect example, but I think it's a milestone, it's an era that nearly all of us can kind of look at life in terms of. And the feature about pre-COVID versus post-COVID was the interest rates, how they were affected, the inflation rates, how it took off basically after the COVID era or during the COVID era. What was life like before COVID? COVID also caused a lot of migration shift patterns as well. So COVID, I think, will go down as, just like the great financial crisis. I think COVID will be another milestone in which we look at the world, and I look at it the same way. So on the left, we've got housing market data. So green line is number of days on market, and then the blue is median sales price. So median sales price here and number of days on market here on the right. So the good news is that before COVID, actually, houses were typically staying on the market longer than they are today. And that's a good sign for folks like us. That means that there's a healthy market in terms of demand for the types of houses and single family properties that we're dealing with. It would be a bad sign if houses are staying on the market longer and longer and longer and longer. And it would indicate that the prices will have to come down most likely in order for houses to stay off, to basically get out the door quicker or not to stay on the market longer. The other thing is, the blue is the median home sales price. And so before COVID, the median home sales price on average is around 250K, right? During this pre-COVID era, 250K, it's kind of splitting the difference. After COVID, we saw a huge increase in prices, in home values. So now the average or the median home price is around 400 to 450K. That is also a good thing for a lender like us because we want, as a lender at least, we want ever increasing values buttressing our loan or our collateral. So what's unique about Trophy Point is that our average loan is $250,000, and it's deliberately that way because it's a lot easier for us to get rid of a $250,000 problem versus like an $800,000 problem. And if America is basically willing right now, market rates, equilibrium rates, is willing to kind of stomach $400,000 homes, and my collateral is only $250,000, that means that the number of Americans that could theoretically buy our properties is a lot quicker, which is great from a liquidity standpoint. And I'm setting the stage later for why this matters, but these dynamics are positive basically for what we do. But it's also attracting more competition. And so it has like another effect on the back end, which I'll get into in another slide. On this chart, I've got gaming revenue. Is this scientific? I think it is, in the sense that the American Gaming Association publishes revenue quarterly on how much people are gambling. Do I think the Federal Reserve is making decisions based on gaming revenue? I don't think they are. But I do like it for market sentiment. And so the interesting thing is, we hear about job losses, we hear about negative impressions of the economy, we hear a lot of negative news and a lot of fear around what's going on. And that, I think, if you read those headlines, you're always going to see that fear, actually, if you just stick to headlines. But I like to stick to data. And whenever I see the revenues of the gaming industry increase, I feel like, Americans, by and large, if they're willing to gamble, which is probably the most discretionary type of thing you could spend your money on, foolishly, I would add, but It's still a discretionary income thing. As a barometer of sentiment, if people are spending more and more on gambling, then there may be something there about how people really feel about the economy and their money. So that being said, gaming revenues post-COVID, minus, the actual COVID period of 2020, have been at actually record highs. In fact, before it was around $10 billion a quarter. Now it's like around 16, $18 billion a quarter. So people are gambling, and sentiment is still positive as far as, spending on the most discretionary thing you could ever think of, which is gambling. Yep, I just got a couple more beeps that some more people joined. If you just joined, please go ahead and ask questions on the Q&A button on your Zoom panel right there. So inflation has been probably the biggest headline economy wise for the last couple of years, and it probably cost the Democrats and Joe Biden the election, frankly. Even though I will say that inflation usually occurs years in advance before it finally actually shows up in data. But in any case, inflation has been, I wouldn't say tamed completely. I say it hasn't been tamed because the target rate for the Federal Reserve is 2% annualized increases. And right now, based on the latest data, inflation's around 2.5, 3.5%, depending on how you track that data. So it's not great, but it is coming down. Inflation rates have like a strong correlation with interest rates. And so, as you all know, we had very low rates of interest coming right off of COVID, but it caused a huge problem of many people trying to buy houses, which is what you saw in that last slide, that the demand for housing shot up dramatically because cheap debt basically allows you to buy more house. On the flip side, though, inflation has a tendency to erode, not tendency, but inflation does erode purchasing power. So far, I think we're hitting a healthy medium between inflation eroding purchasing power, but yet housing values are still staying the same. And my opinion on this is that it's not like 2008, because in 2008, the underwriting was terrible. You basically had inflated demand because of just terrible underwriting. And on top of that, we had, 300 million Americans back then. Today, we have 330 million Americans, maybe even more if you count undocumented folks. And so the number of available housing units is still short of where we need to be. And on top of that, because of what was going on with inflation and all that stuff in the previous COVID era and regulation wise, we were not building enough housing units to begin with. So it's caused like a shortage of housing. So here's the other thing that I care about a lot. We are entering probably a secondary era, and that is the Trump tariff era. As many of you know, if you don't know, President Trump has initiated tariffs, reciprocal tariffs in many cases, but tariffs against Canada, Mexico, and China specifically. If you didn't know this, we get about a third to maybe half of our lumber, depending on which market you're in, a third to half of our lumber from Canada. That lumber is a critical building material. The pro of that is that it may improve domestic production of building materials, reducing reliance on imports. That's a great long-term sort of thing. But it takes time for domestic production to catch up with that type of trend. In the short term, we may see a shock, and that's why the cons that I see that I've listed here threaten basically us as a fund, as the industry. So tariffs, will increase construction costs like lumber. Steel doesn't really matter for us because of our asset classes that we focus on, but generally construction expenses will be higher. Tariffs have been known to increase inflation because typically businesses will pass on that tariff, that cost, to consumers, resulting in higher costs for everything. If that's the case, then it could cause the Federal Reserve to keep inflation rates higher in order to arrest this inflation that's occurring. And that's not necessarily a bad thing for folks like us as a lender because we get to charge higher rates. But it does hurt us on the back end because we still rely on the overall banking industry to lend to our end buyer or to the end buyer that's buying the collateral of our borrower, of our clients. And I think it's going to exacerbate the affordable housing shortages I alluded to earlier. I mean, if costs go up generally and numbers and projects are not penciling out for developers on new home builds, then they're not going to build, or they're just going to sit on a bunch of land. And our population is still growing. It may not grow as much because we're going to probably reduce immigration. And this country relies a lot on immigration, but we're still growing as a country, even if it's 1%, 2%. It's not going to get any better, which actually in the grand scheme of things, a housing shortage is the best thing for folks like us because That means that the collateral that we're sitting on, the $83 million of collateral that we're sitting on, there's a much larger likelihood that that collateral will never be impaired, which is even more important for me because I have $8 million of my own money riding on it, on losses or not taking losses. You probably know this supply chain also gets disrupted because when you go from imports to having internal domestic production, the whole supply chain was built around, the ports, built around imports and flooding the country with imports because we have an over reliance on imports. The supply chains won't get disrupted because now you have to shift on where that stuff is coming from internally into the country, which disruptions basically mean more cost. So overall, I think the tariffs are going to have a net impact on construction costs and things like that, and it's going to exacerbate things for regular people. But for us as private lenders on real estate, it could be another barrier of something that helps us at least preserve what we already have. It may not help us on the future in terms of future lending, but for the $83 million that we have currently, I don't feel terrible about it. All right, so growing competition. So this is one of my favorite things I wanted to talk about, actually. So actually, we got a question. Let me hit that question up. So someone says tariffs do not cause inflation. It is the money supply. I disagree. I think inflation has a lot to do with the money supply, but if costs are going up for the basket of goods that defines inflation, and those costs are increasing because of tariffs, then you're still going to have inflation. But we'll see. I hope I'm wrong. Thank you for the question. So the growing competition. So it's no secret since 1980, basically, that the number of commercial banks in the United States have been decreasing. So in the 80s, we had around 15,000 public commercial banks, and it's dropped by, basically 66% to around 5,000 institutions. There are many reasons for that. Regulation is one of them. Then the 80s, the savings and loan crisis definitely destroyed a lot of financial institutions. Tax changes in the 80s also caused disruption in how real estate was priced. Banks took it on the chin as a result of financial deregulation in the 80s and tax changes in the 80s. And then 2008 put another nail in the banking sector coffin. And I don't think banking is dead, to be clear. So I shouldn't use the word coffin. But I think the number of banks that are available to lend publicly in the way they do it decreasing as a result of the regulations and things like that. And it's possible that President Trump may unwind a bit of that. And I think we're seeing some of that already with the curtailing of the CFPB, which was the main organization that governs lending and stuff like that in America to consumers. And he's basically all but dismantled it at this point. So, but anyway, the number of banks have declined considerably in the country. And what does that mean then? Has the country been borrowing less since the 1980s? No, absolutely not. So private credit or private lenders like ourselves have been filling this gap. And it's grown by a lot. I mean, it was 1.5 trillion in 2024 at the beginning of 2024. And it's accelerated dramatically now to 2 trillion. It was $500 billion have come in just 1 year. That's pretty large. Money is flooding this market. So keep that thought in mind. In 2011, the number of private lending funds above a certain level, I think that the number we used was 100 million or more funds, and not funds, but operators with 100 million more in assets across multiple funds. The number of operators in 2011 was like around 100. Not that many, but there were some large players still. Now that's gone tenfold to 1,000 as of Q3 2024. Private lending is absolutely filling the void that commercial banks cannot fill. And I think it's also becoming easier for private lenders like us because software is also now eliminating some of the barriers. Banks had a lot of infrastructure to lend money, take deposits, lend that money, and stuff like that. And it's a very manual intensive process, or at least it was. But now with the introduction of fintech and other tools and cloud-based banking and money transfers, basically, even smaller funds like ourselves, that we get to take advantage of that. It's just a whole lot easier for us to do the same thing without the regulatory and compliance burdens that the banks suffer from. So private credit is probably going to be the story for where you can obtain yield in the near future, unless the banks turn it around and get over some of the infrastructure challenges that they have. And now, as a result of I'm in real estate lending, but when you come across middle market lending, like private funds are now even doing business loans to a greater extent that the banks used to do. And so private lenders are also doing more of that as well. which is a little bit riskier because their collateral is basically the receivables or the income or the revenue that those business loans get. Whereas we, as you know, take first position lien on real property, on real estate. So we'll see how that plays out for the private lending friends of ours that do it on just business loans. So Trophy Point has grown dramatically from a lot of these trends. I mean, we are directly benefiting from the fact that banks cannot lend as much. And we've made a name for ourselves as well in terms of great customer service, doing what we're saying we're going to do, closing on time, things like that. And we haven't spent a single dollar in marketing yet on obtaining borrowers, actually, which is crazy to me. And we've lent out 200 million over the last 4 years. So let's see. So the green is the volume. The green bars are the volume, and the blue dots or the blue line is the number of loans. And so we started out with like, a couple million in our first quarter in 2020, which is what you see here, the first bar. And then in quarter 4, we originated close to $18 million of loans. And then we also originated 100 plus loans in that quarter as well. So we've just grown steadily as well. And then more importantly, we're also getting paid back on loans, which is even more important. And you can see that the blue is number of paid back and the green is the dollar volume of paid back. So we're growing. The market is shifting away from banks. More money is flooding our space, right? Like I told you, about 500 billion has come just in 1 year alone into our space. How are we adapting? So it boils down to 3 things: the right team, the right type of pricing, and client service, right? And the right team and the right pricing, I think, provides more client service. And so I'm not going to read all the bullet points, but we've taken a lot of steps and we've added a lot of people into the team to do all this sort of stuff. I'll hit on standardized pricing because I think that may be the bigger one for a broader audience today that we want to talk about. In the past, we were very bespoke. We took a lot of time to listen to the borrower on what they wanted, and we basically crafted a lending program or a loan program or loan terms around what they wanted and the types of risks that we're taking. Now, because we're getting so much volume, we've moved to more standardized pricing terms. And there's pros and cons with that. The con is that we're less robust, I guess, to what the borrowers want. But the pro is that we can now like adequately track like how we're doing with our pricing in terms of like knowing what works and what doesn't work. Because when you're just bespoke, you don't really know what works from a broader trend necessarily, on like ensuring that what we're charging is enough to cover our investor base plus the additional profit that I want to earn. But with standardized pricing, we also help our customers, our clients, know what they can expect. And I think in the long run, standardized pricing will allow them to like save them a phone call with us, even though we'd love to talk to them. It saves them a phone call of trying to kick the tires with us. They already know what we're going to charge. And it allows us to be better at predicting what our future revenue could be in terms of like making sure that we're covering all of our obligations. We're also shifting to doing more business with clients that have, 10 or more deals per year. In the past, we're welcome to do business with anybody. But in the past, you occasionally get that flipper that does 1 or 2 flips a year. Now, because this industry has become more robust, we're trying to emphasize doing business with folks that do 4, 5, 10 plus flips a year. And they're more professional about it. They've got their own crews. They're optimized internally to handle higher volume. And that's actually a risk mitigation strategy for us to deal with those types of professionals. And also it helps us because they're not going to do all their loans with us, but they have other assets and they have more stuff to lose potentially if they screw us because, again, they personally guarantee all of our loans. So I'll say this, that like customer service in this business matters a great deal. And it's unique that we haven't spent $1 in marketing yet to get more clients. But that is going to change probably going forward, that we are going to kick off marketing in Q3 or Q2 of this year because Trophy Point's overall goals is to grow. I know we have the right team. I think we've got the right incentive structures internally as a fund. And now with 200 plus investors, we've got a base of investors that I could theoretically flex to 120 million actually if I really wanted to meet growing demand. And so our goal over the next 6 to 12 months is to generate demand, not organically, which is basically through advertising and marketing and things like that. The other thing that I'll mention is that we have access now to capital markets. And so we have got lines of credit with banks up to 27 million. We haven't drawn on a fraction of that actually. We typically use the lines of credit in order to make loans quickly and then backfill it with investors that come in. And we're raising 3 to 5 million a month now. In January alone, we raised $6 million from investors, but we also have additional capacity on our line of credit as well. So we've got a lot of capacity. We've got a lot of things going for us. And so this adaptation plan that you see here is our plan to basically take advantage of the fact that we've got a lot of dry powder, or rather access to dry powder, and meet the demand. And I feel good about it because I think housing values are staying pretty stable. I think the tariffs and some of the things that are else going on actually help us as lenders. And high interest rates also hurt the banks, but it doesn't hurt us as much. So it could be good, I think. I would welcome any questions. I would welcome your feedback on a lot of this stuff. I know I said a lot. Trophy Point, like I said, we offer fixed rates, so 8 to 12%. And you can see the investment amounts here on standard investments. And then we have a bit of incentive for IRA investors because we like our IRA investors. You're less likely to redeem. We offer a greater return profile. One thing that is new for many of you that may not be aware, we changed our tier to earn 12%. We increased it to $2.5 million instead of the $1 million. And that program has ended for $1 million investor. Those that were $1 million earning 12%, you've been grandfathered in. But going forward, if you see some of our older marketing collateral, you'll see 12%, 1 million. Well, that's no longer the case. It's 12%, 2.5 million to earn that. And honestly, this is really for our institutional investors and our family office clients. We have a segment of investors that are family offices and institutions, actually, and endowments. We've had our first in 2024. We scored our first private endowment investment of $4 million as well, and so we wanted to craft that 12% really for them, and you know, it's easier to raise those types of dollars for those larger types of investors. But anyway, it's paid ACH. You can auto reinvest it, so you can compound it if you want. It is 1099 income, 1099 INT income. It is locked up for 18 months, though it is negotiable if you're willing to take a lower rate. And like I said before, I have $8 million of my own money in the fund, and I take the first loss on any bad decision my team or I make. So I like to think I'm incentivized fully with you. So that's it. I think we did pretty good on time, actually. I'd love to hear your questions, love to hear your feedback. If no questions, thank you guys so much for joining us. All right, well, everyone have a great week. And like I said, I'm only an email away. My cell phone number is here. You also have my office line from the previous slide. And let me know if I can help you with anything. Thanks very much. Have a great day.